Hi, I'm Beth Gantz. I'm the director of the Small Business Development Center at Lorain County Community College. And today I'm joined by Toby Kaye of the Thyrve Group. Toby is a friend of the SBDC, a small business owner, and also an SBDC client. So, Toby, I'm thrilled to talk to you today about taxes. But tell us more about your business.
Sure. So founder and CEO of Thyrve Group. So we provide accounting department as a service for small business owners, including fractional CFO, bookkeeping, and tax. And our goal is to really change how the whole accounting industry works, make it really customer focused, high responsiveness, and really proactive. A lot of tax planning, a lot of financial planning to make it for what small business owners really want. So I'm excited to be here to answer some of your questions for everyone.
I am too. We work with a lot of clients, as you know, and we are not CPAs, so we're not allowed to answer tax questions. So I'm glad you're joining me today to answer some basic tax questions.
Sure. And just before we start, there's probably a couple points this is going to go up and onto the internet for everyone to look at, but obviously the tax law is only up to date that we talk about up to today. In a couple of months, you have to check if anything changed. And the other part is that you have to understand your own situation and see, hey, do any of these tax planning ideas work for me in your own specific personal situation?
Yeah. So as of February 15th, 2024, it's up to date. But after that, make sure you do check and make sure it's up to date for your situation. So one of the things that happens is we get a lot of people that come to us who aren't ready for an LLC, but they've started their businesses, so they're sole proprietors. So they're like, well, what do I do? What forms do I fill out? So, what do you suggest a person does who hasn't filed an LLC yet? And is it different if you file an LLC?
Okay, yeah, that's a good question. So when we can look at it from kind of a tax perspective, we'll look at it from a tax perspective first, and then there's also, hey, when I'm just starting a business, what type of form should I file? So when it comes to your taxes, there's not a big difference between if you create an LLC and you run your business out of a single member LLC where you're the only owner, or if you're running it without an LLC. There's a lot of different types of taxes that you may have to file. So it could be, you have income tax, it could be sales tax, and there's also payroll withholding taxes. All of them have different forms. So for example, for the income tax, your 1040 is for the federal return, and the state, if you're in Ohio, it's IT 1040, and then you may even have a city tax return. So depending how you run your business, you could have multiple taxes that you're paying at the same time, but there's no difference whether you run it without an LLC or with an LLC. Okay. So some other things that you should think about when you're starting the business. One is to apply for an EIN. It's going to be important. If you start running payroll, or a lot of times if you want to file different other forms, if you want to open up a bank account, you have to have an EIN. So that's usually pretty easy and it's free. Just go on the IRS website. And then also a good idea to create a business bank account separate from your personal account. And that'll just make understanding what your business is really doing easier, because only the business related transactions are the ones that are going to be relevant, whether it's for filing your taxes or at least to know, hey, how much income are we making? Where are we profitable? So those are two things to start off with right away when you open up the business.
Okay. And my understanding is if you start off as a sole proprietor without an LLC, but you get an EIN, if you move to an LLC, you have to get a brand new EIN number. I don't think they match. I'm not sure though.
You don't. Yeah, usually you. I'm not sure about that.
Right. I'm not sure either.
Yeah, you may be able to keep it if it's still the same. If it's still the same business.
Yeah.
And just creating the LLC. The LLC is more created at the state level, like with the Secretary of State, compared to the IRS is the one who gives the EIN.
Okay. Yeah, just something to be thinking about and stuff like that. So that you may have to change that, but you definitely need one to open a business banking account. So it's everything. Yeah. So we also, I've got an LLC, but like life happened, didn't start my business, or I'm not ready to start right away, do they still need to file that 1040 or, file the personal tax, income tax?
Sure. So assuming the business owner doesn't have any other income, right? Obviously, if you have another salary that you're bringing in or other businesses, you have to file for that anyway. So you'd have to file income tax. And just say you have nothing, no other income, and maybe you have some expenses because you just started the business, you haven't made a sale yet, then technically you wouldn't need to. You wouldn't need to file a tax return because you don't have any income to pay tax on. But it may be a good idea, especially if you had losses, to file the tax return because that reports to the IRS, hey, I have these losses, and then you can carry forward those losses potentially to a future year. Just say the next year you make some income, you can use those losses against that income. If you never report them to the IRS in that first year, they're not going to have it in their system that it's available for you to use.
Okay, that's really good to know that you can still write off those expenses. So I did not know that. So I learned something. So, the other question we get is, well, do I really need an accountant? Do I have to have an accountant for your small business? Our answer is yes, because, as a small business owner, the numbers tell the story of how you're really doing, right? And it's really important to really understand the financial part of your business. But, do you think you need to start with an accountant?
Yeah. Sometimes people feel pressure to, jump to get an accountant right away. So obviously it's best practices for every business owner to have an accountant eventually, just to be able to understand really what's going on from a financial perspective with your business. But when a business owner is just starting out, it may be, that they don't have too much going on in the business yet. They have just some transactions, and there are a lot of self-service ways that are available now with the technology to be able to keep your books. Like QuickBooks Online or Xero, a couple of quite popular cloud-based bookkeeping softwares, and then also things like TurboTax, where you could just file yourself with your tax return. If it's simple. But over time, that's something you want to start developing a relationship with an accountant that you trust, just so that you can see the different perspective in what your business is while you continue to market it, grow the operations. There's someone else with financial expertise that's on your team.
Sure, absolutely. And oftentimes accounting firms have bookkeepers, or can refer you to a bookkeeper too, if you need that kind of assistance as well. So the second question we get all the time is, well, what can I write off? Right? Like how much can I write off? What can I write off? And so, can I write off all those coffees I go to? But anyway, so what are some suggestions you have about writing off expenses?
So that is a pretty common question. So there's really, it's more of a broad way that the IRS has described it. So I'm going to use the terms they actually use, which are that the expenses can be written off if they're ordinary and necessary for business. So the IRS doesn't want to prescribe exactly, every single expense, because every business is different and every industry is different. What is necessary for your business to function as a business, might be very different than, your neighbor in the same office building.
Mhm.
But on the other side, something that's a personal expense, right, not related to the business at all. For example, something like clothing that anyway you would need to buy, even if you weren't in the business, then that would not be deductible. If it was a specific type of uniform or something that was specific to the business, there's potential that could be deductible. But even if someone says, hey, I'm buying a suit because I want to look good for an interview, things like that. Unfortunately, people wear suits all the time anyway for all types of things. So those things would still be personal.
Okay. Yeah, wouldn't we all love if we could write off our shopping sprees, right? So
Sure.
right, exactly.
And the coffees that you mentioned. So,
Yeah.
I mean, sometimes those can be personal, right? When you're
Right.
going out for coffee.
Right.
But if you're going, let's say, for a business meeting, or you're going to meet a potential client or a vendor, then those can be deducted. They have a 50% deduction on those type of meals that are related to business.
Okay. Okay. So so someone can take us out to lunch. Anyway, talk business. Anyway, so and then we always get the question about sales tax. And I know that the state of Ohio does have a pretty robust frequently asked questions section, but how do they know if something they need to collect sales tax or not?
Yeah, sales tax does get confusing. Because there's general rules and then there's exceptions to the rules and then there's exceptions to the exceptions.
Right.
So it's something that is easily when a lot of business owners start, I mean, they understand they're going to pay income tax if they make income. The sales tax sometimes is kind of like the shock of them. Okay, now I have to collect this from every customer. How's it going to work? So it's really important right when you begin to understand whether you need to collect the sales tax. And it's really based on what you produce and the type of industry that you're in. So that's, as you mentioned, the Ohio Department of Taxation has a lot of good content related to sales tax on there. And the general rule is if it's a product sale where your tangible product that you're selling, there is sales tax that should be collected. Services do not have sales tax necessary on them. Now, then there's a whole list of products that are exempt, and then a whole list of services that really are taxable, specified services. So you really need to check on that website. Do we fit into which bucket? And then collect the sales tax, remit it, usually once a month, and report it. The actual process of reporting is really easy. On the Ohio Business Gateway, there's no calculation. Just okay, this is how much sales I collect. This is how much tax there is, and you send in the money. The harder part is if you hadn't done it for 6 months, a year, 2 years, and you're behind, and they have to catch it all up. It's the business owner's responsibility. The government will say, "Hey, you were required to collect it. In the end, you didn't collect it, but it was your responsibility." So, you can't go back to, you can try and go back to all the customers and try and get the sales tax now, but in the end, if they don't pay it to you, it's your responsibility as the owner. So that's why it's good right off the bat to make sure that you're in the right spot.
Even if you have to 1 month say 0 sales, right? You still need to report because they'll fine you and they'll think that you're selling stuff. They don't know what you're doing. And so you need to make sure you're up to date with that. So, yeah. So running, I have a job while I'm running my business. How much should I set aside for taxes? If I have a business, can I wait until filing my tax return to pay my tax do I need to pay estimates basically? Or, yeah.
Good. It's good questions. A few different questions there. So one is in terms of how much tax should I put away? So, obviously it depends, right? So that's the great answer accountants can always give. But the tax code is built on kind of progressive taxation. So as you increase your income, it gets taxed at a higher rate. Now it's only the amount that's above that particular tax bracket. I would get a lot of questions where people are like, well, if I go in the next tax bracket, it's going to be a huge hit. They think it's going to tax everything below that at that higher level. But it's really, if you're $1 above that bracket, just the dollar gets taxed at that higher rate.
Okay.
But that's where it makes it difficult to give a broad answer here to this question, because if you're in the 35% rate, 37% rate, 24% rate, obviously you should be withholding or putting aside less or more money on every month. So if you have an accountant, it's a good idea to ask them to do a tax projection in the middle of the year. Hey, what's it going to look like? You can make sure that you have it all set aside.
Okay.
If you have also a job where you have a payroll, and this is kind of like a side hustle, you can always ask the payroll there to have kind of extra voluntary withholding. They're going to withhold assuming you just have that salary. You can always say, hey, you withhold an extra $300, $500 or something every pay period, and then it'll be remitted to the government. So it'll pay the taxes on your business. But if you're not doing that, then really the government wants you to pay in quarterly estimates, as you mentioned, based on what your assumed or projected net tax payable will be. And they're
Okay.
due April 15th, June 15th, September 15th, and January 15th.
Okay.
And as long as, as long as you paid in based on what you owed last year, kind of split over a quarter like a safe harbor, then even if you owe a little bit at the time of the return, as long as you paid in those quarters based on what you knew from prior year's return, then you won't get, you shouldn't have a penalty.
Okay. Okay. That's a great idea if you still have a job, to have them hold some back, because especially if you're used to getting money back on your taxes. Usually when you have a business, you're not, that's extra income thing, it's sometimes you get a little shocked when you might owe because you didn't hold enough back or something like that. So that's a great
that's
idea.
something that happens a lot, that a business owner should understand when, when they're making a sale, right, and they're making some net income, a portion of it's going to the government. So, they could put it aside. I mean, best practice is kind of just putting a little bit aside each time. But even if you don't put it aside, you just in the back of your mind know, hey, it's not available to reinvest in the business, right? Maybe the business owner wants to grow and invest in some equipment or invest in a new location or whatever, but they have to have in the back of the mind that, a certain percentage of it's going to go to the government. It's not really available to me. I'm going to have to pay it in a few months.
Sure. Okay. I just have a couple more questions. So we do often help our clients find, with equipment financing, and find opportunity to finance equipment through a company or rent equipment. So for tax purposes, what is better? Is it better to rent or finance or finance the purchase of the equipment?
Yeah. So from a rental perspective, as you're paying out the rental every month, you're deducting it, or if you're on accrual base, that's if you're on cash basis. If you're on accrual basis, maybe you would accrue the last month. But in general, you have a year's worth of rental payments that you can deduct. Now, when it comes to financing, where you would get a loan for the equipment and kind of pay that, let's say over 5 years or whatever, there's actually different rules in the tax code which allow you to accelerate the depreciation. So you could actually have, a few years worth of deductions of your payments all in the first year, even though you're paying and your actual cash flow is going over time. Okay. So from a tax perspective, if you're looking for deductions now, it could be better to finance. Now, tax is only one part of the equation, obviously, of buying the equipment, right? What interest rate are they giving you, and how long are terms? What's the what's the pricing that they're giving to you, and the features, right? There's a lot of tax can always only be one part of the decision to buy, but it can be a sizable difference in that first year, where you get a little bit more tax back.
Okay. Interesting. That's okay. I didn't know that actually. So again, I learned something. So, of course, everyone wants tax benefits, right? And no one wants to pay taxes, but we do. But does the state of Ohio provide any tax benefits to business owners compared to other states?
It's actually, Ohio's a pretty tax friendly state, in general, especially compared to, the East or the West Coast. So for business owners, if you're married filing joint, then you receive $250,000 of exempt income, of business income. We don't pay any state tax, any Ohio state income tax. If you're single, it's 125. So and anything above that is only taxed at 3%. So if you're looking compared to something like California, where it's, I don't know, 13% is the top rate, or New York, where it's like 12 or 13. So it's really significant difference in terms of not having any tax at all. One negative side is the city tax, which is an administrative burden. Many cities have their own tax in Ohio, which is kind of unique out of most states in America. And so there's filings to do, and there's also usually 0.5% to or 2.5% they have to pay to the cities. That's kind of one of the harder parts of being a business owner in Ohio, is some of the extra jurisdictions that you have to work with. But overall, Ohio is a really, really tax friendly state.
Oh, that's really good to know. So yeah. And so, you have to file your taxes, but you have to gather the information to do that, right? So instead of having everything in a shoebox, right? What practices do you recommend on setting up systems and processes so it makes tax time easier, or makes it easier for your accountant to help you, and less headaches and less running around the house? Where did I put that receipt and all of that stuff?
Right. Yeah, that's the quickest way to get your account to pay. And if you want to, just come in and bring in a shoebox, especially like on April 14th or something the day before.
Yeah.
Um, so no, we want our accountants to stick around. So, best practice, like we said about, first step, okay, create a separate business bank account. And then many of the accounting softwares, you can just kind of attach that business bank account to the system. So the transactions start pouring in. And then you can categorize them inside the system there into, whether it's income, expenses, loans, whatever type of transactions that they relate to, in order to kind of build your income statement and balance sheet over time instead of waiting till the last minute. And then at the end of the year, you'll just be able to run an income statement or something like that, or your accountant can actually go into a lot of those online ones even without you having to pull the report from them. You can give them user access. They can go in, just pull the report, and then they can just do what they have to do without even having to bother you.
Okay, great. Well, Toby, thank you so much for joining me today. It's taxes are always, everyone wants to know what's this going to cost and what do I need to do, right? And so while we can't answer your tax questions at the SBDC, we can certainly help prepare by helping you understand how to use QuickBooks Online, Xero, Wave apps, or another system to keep track of all of this, to make it easy on your accountant and on yourself. So I really appreciate it. Is there anything else you'd like to mention, or any other tips you have?
No, it was great speaking with you, Beth, and I appreciate the opportunity.
All right. Well, thanks so much, and hope to talk to you soon.
Thanks. Bye.